Hello everyone, I'm Siddhant. Today we are taking the chapter number 16, that is the funding and the regulatory aspects, in which we see that how RBI makes some rules related with the banks and how they able to comply us with that rules. So this is all about the different norms, reserves, etc. of the RBI applied in the banking system. So starting with that, the first is the CRR and the SLR. The CRR is the cash reserves ratio and the SLR statutory liquidity ratio. The RBI gives these norms to be complied by the banks, and the CRR is 3% of the demand and time liabilities, and the SLR is to be maintained 18% of the net demand and time liabilities. We will first see the difference between the demand and time liabilities and the net demand and time liabilities. The demand and time liabilities composes of the demand deposits, the time deposits, that's it, that is the demand time liabilities, and net demand and time liabilities, the total demand deposits plus the total time deposits minus the amount that is kept with the RBI, that is the net demand and time liabilities. So this is the basic difference. Now CRR is to be maintained by the bank as per which act? It's RBI Act. And SLR is to be maintained by the bank as per Banking Regulation Act. You can remember this with the trick like cash CRR is to be maintained with the RBI, but the SLR is to be kept with the banks only. 18% whatever of the NDTL is to be kept with the bank itself, and the bank has to send a report to the RBI as per the need. But CRR is to be maintained at the RBI accounts. So that's the difference between the CRR and the SLR. So how to remember that CRR is complied by the RBI Act, and the SLR is through the Banking Act. Like the CRR, what is this? Cash is to be kept with RBI, so it is complied by the RBI Act of 1934. And SLR, statutory liquidity, is to be maintained with the banks, so it is regulated by the Banking Regulation Act of 1949. So this is the thing. Now next concept is the LAF. What is LAF? It is called a liquidity adjustment facility. It's a principal operating instruments of the RBI monetary policy. So you must have heard that RBI in bi-monthly RBI changes its monetary policy stance. What does it mean? It also changes in that monetary policy. It also exercises LAF, that is liquidity adjustment facility. LAF is nothing but a repo. Through repo, how the RBI changes the scenario or the economy of the country, that is the liquidity adjustment facility. That's it. And LAF also comprises of reverse repo. Now we will see the basic thing, the basic definition or the basic understanding of the repo and the reverse repo. For example, let's say you are, as per the Banking Regulation Act of 1949, you need to maintain 18% of the SLR. Okay, but somehow the banks has managed to maintain 25% of the SLR. So there is a 7% of the SLR is extra. So whenever the bank needs money, with this 7% of the SLR, they will reach to RBI and telling RBI that keep this 7% of the securities with you and give me money against it. So RBI agreed to do this. So this process is nothing but a repo transaction. And now what is the full form of repo? That is repurchase rate. Repurchase means the banks promised RBI that after some time I will repurchase these government securities again and pay you the money that you have given now. So this is the repo rate. And reverse repo is the other side of the repo. For example, if the bank has extra money, so they keep this money with the RBI, they park this money with the RBI, then RBI gives some interest, that is the reverse repo. So that is the difference. Now there is some other tools like MSF, marginal standing facilities. Now what if that extra 7% exhausted in repo? Now the bank has nothing to give to take loans. Still the RBI agreed to give loans with this 18% of the SLR to be kept as a security by the RBI and give the money called the MSF transaction, that is marginal standing facilities. And when repo is for the short term, and when the repo loan is for the longer term, then that is called as a bank rate. So these are the basic difference of the all the monetary policy tools that I have discussed. Now we will see the questions. Okay, before that we will see what is PSS, that is payment and settlement system. It is this payment and settlement system existed in our country as per the Payment and Settlement Act of 2007 of the RBI. There are various instruments that runs the PSS system into our country. For example, the RTGS, real time gross settlement. So it's whenever you want to transact one-to-one transaction, and at a time transaction means if you want to transact immediately, you choose this RTGS system. It is more than 2 lakh and above, and the UTR number that is generated is 22 digit in number, 22 alpha digit, and the timing of the RTGS is 7 a.m. to 6 p.m. and it's a cost push transaction. These things you should keep it in your mind. The next the tool or the instrument that is under PSS, that is payment and settlement system, is Infinet. What is Infinet? It's a information financial network, the full form of the Infinet. And this Infinet is developed by the IDRBT, that is Institute for Development and the Research in the Banking Technology. And this Infinet, that is information financial network, there is a platform called the SFMS, that is Structured Financial Management System. So in this system, what is the use of this system? This system is used for the communication between the bank to bank, between RBI to bank to bank. There is a need of secure communication. So this SFMS gives that communication channel. So you have understood SFMS. Now next is the NDS, that is negotiated dealing system. So what is this negotiated dealing system? It is nothing but an electronic platform for the government securities, money market instruments, etc. So in this negotiated dealing system, through electronically we can it's an automatic reporting system. Automatic settlement process can be taken place in this NDS, and auction on the electronic platform is also done through this NDS. Next instrument is the FX Clear, that is forex. It relates with the forex dealing. Whenever you whenever banks want to buy a dollar or sell a dollar, so there would be some platform where they can do it electronically. So this FX Clear system gives that platform, and it is developed by the CCIL, that is Clearing Corporation of India Limited. Next instrument is the NSDL and the CDSL. NSDL stands for National Securities Depository Limited, and CDSL Center Depository Securities Limited. NSDL maintains for NSE and CDSL maintains for the BSE. So what they maintains the shares in the electronic form. So that's the NSDL for you. Next we will see NEFT. NEFT is as already everyone knows that the recent news related to the NEFT is that it is now 48 hour. It's a 48 batches that in a day that can be transact through the NEFT. It's a half yearly basis. The batch can be made and sent, and in NEFT there will be a UTR number of 16 digit, and the timing of the NEFT is 24/7 now, and it is a batch transaction. That these are the basic things that you should keep it into your mind. Now we will see the questions. The first question is the M3 or the broad money has. Okay, we have read this M3 some previous chapter, in the previous chapter as well. Now we will revise. Now M3 is equal to M1 plus time deposit with the banks, that is M3, and M1 is equal to currency with the public plus demand deposit plus other deposit, that is the M1. Now M1 is also called the narrow money, and M3 is also called the broad money. And currency with the public is nothing but the currency in circulation minus bank deposit. For example, the currency in circulation means whatever the RBI prints comes into the market. Now, when it comes to the market, with the people like us, what we will do? We will keep some amount with the bank. We will keep something in our hand. So that currency in public is equal to currency in circulation minus bank deposit. So that these things you should keep in mind. So M3 or the broad money has which of these as a components? Currency in circulation, yes. Demand deposit with the banks, yes. Time deposit with the banks, yes. Borrowings and the refinance by the banks, no. It is not. It is not the component of the broad money or the M3 or any M1, you can say. Purpose of the monetary policy. So what is the purpose of the monetary policy? The purpose is very simple, that is to regulate growth and to control inflation. Next question, which is the indicator of the money supply that has not been absorbed by the real economy? Okay. Okay, which is the indicator? So when can you say that whatever the RBI is sending, it is not absorbed in the economy? When can you say that? For example, in the monetary policy, the RBI reduces repo rate. Why they are reducing repo rate? So that it can reach to the banks, the amount, the money that can reach to the banks easily. The bank can easily take the loan from the RBI. But when the banks take the loan from the RBI easily, but not giving that money to the customers, then what will happen? The surplus of the funds created by the banks. So the option A is the right answer. Surplus funds available with the RBI. Next question, shortages of the liquidity will do. Okay, whenever there is a crunch in the money supply in the market, so whenever the money supply will be less, the demand will be less. When the demand will be less, there will be inflation will be lowered. So this D is the option. Now we will see other options as well. Hampers growth. Yes, whenever there is less demand, there will be that will hamper our growth as well. So B is also the option. Now we will see other options. High interest rates. Yes, if there is a crunch in the money, there will be more demand of the loans. So whenever the more demand of the loans, the interest rate will get high. So option A is also correct. Option C, depreciation of the rupee exchange rate. Yes, this will also happen if the shortage of the liquidity occurs. So all the options are correct. So answer is all of the above. Next, minimum and the maximum CRR can be. It is as prescribed by the RBI. For example, in the demonetization, the RBI increased it to the 100%. So it all depends on the RBI. Next, CRR governed by. I give you the trick. Cash is to be maintained with the RBI. That is, CRR is to be maintained with the RBI. That 3% of the demand time liabilities, that is to be maintained by the RBI. So when it is maintained by the RBI Act will be applied. And SLR is to be maintained with the banks only. And when it is to be maintained by the banks only, so the Banking Regulation Act of 1949 applied. Next question, which of the following is the component of the demand and time liabilities? I already discussed. So the demand deposit, yes, it is the component of the demand and time liabilities. Time deposit, yes, it is also the component of the demand and time liabilities. Option C, foreign outward remittances in the transit. You need to remember this fact that foreign outward remittances in the transit is also the component of the DTL. So option C is also correct. Loans and advances, no. These loans and the advances of the banks are the assets, not the liabilities. So this one is not the right answer. Option E, funds borrowed from the other banks. The funds borrowed from the other banks are also not counted in the component of the DTL. So option A, B and C is the right answer. Next question, bank has to maintain cash balances with the RBI to meet the prescribed CRR on average during the fortnight, subject to daily cash balances not falling below dash of the average fortnight balance. This is a factual. You need to remember this. The option is C. 90% they need to maintain. SLR is not maintained in which of the following? Okay. The SLR, as we know that the 18% we need to maintain with ourselves. So in that 18%, what we can buy as a banker, as a bank, we can invest in the gold investment. Yes, this one is true. We can invest in the approved securities by the RBI. Yes, this one is also true. We can also keep cash and count it as SLR. This one is also true. But the cash that is with the RBI cannot be counted in the SLR. That will be counted in the CRR. So the next question, RBI imposed which of the following ceiling over call and the notice money, borrowing and the lending by the banks as a percentage of their capital fund respectively? Okay, there is lots of concept in this question. First we will see what is capital fund. The capital fund is the equity plus reserves of any company is the capital fund. That's it. Call money, we have learned this call and the notice money in the last chapter. The call money is for the overnight. It means for one day. whenever you need a money for one day, whenever the bank needs a money for one day from another bank, they do the transaction called a call money borrowing. And notice money, when they need money for 1 to 14 days, they do the transaction or borrowing through the notice borrowing or notice money borrowing. So whenever the bank needs money borrowing, how much is the ceiling, how much they can take loan from other bank for one day? It is 100% of the capital fund, that is equity plus the reserves. And in 1 to 14 days, how much they can take loan from other banks? That is 25% of the capital fund. Next question, smaller banks does not have which office under treasury hierarchy? Okay, as we learned in the last chapter, that in the treasury hierarchy we have read that there is a dealing room, above the dealing room there is a back office, lower the dealing room there is a middle office, and lower the middle office it is a front office. And it is asking question for smaller banks. Whenever they ask about the smaller banks of the company, there will be no middle office. So middle office doesn't exist, but the front office and the back office is the must for any office. And what are the functions of this? We will revise. We are revising that what are the function of the front, middle, and the back office. The front complies whatever the rules and the regulation or the policy or the risk, everything whatever they come from the back office or the upward, they need to comply it. Middle office, they connect, they report, they implement the risk and the policy. Back office, what they do? They validates, they do settlement, and they do policy making. Next question, which of the following come under exempted categories where only minimum CRR is to be met irrespective of the actual CRR? So there are some exemption with the CRR. This all the A, B and C, they don't need to maintain the CRR. They need to maintain the minimum CRR as prescribed by the RBI. They don't need to maintain the real CRR that is going on now. So which one is exempted? Example A, net interbanking borrowing deposit with the maturity not exceeding 14 days. Okay, whenever they do interbank borrowing, they are not counted in the CRR. Credit balances in the ACU. ACU stands for Asian Clearing Union. So the credited balance in the ACU is also not counted in the CRR. DTL, that is demand and time liabilities, in respective of their offshore banking unit. What do you mean by offshore banking unit? The banks which have their branches outside our country, that is the offshore banking units. So DTL in respect of their offshore banking unit is also not counted in the CRR calculations. Next question, CRR and SLR maintained at the rate percentage of what and what? We have discussed that CRR is to be maintained with the DTL, that is demand and time liabilities, and SLR is to be maintained with the net demand and time liabilities. We have also learned the difference between the demand and time liabilities and the net demand and time liabilities. The net demand and time liabilities is equal to the demand and time liabilities minus the amount kept with the RBI. So, and demand and time liabilities comprises of all the demands deposits, all the time deposits. That's it. So that's it with this chapter. I have given you all the concepts. No need to read books. You just need to practice questions as much as you can. Please share the videos, like the videos, comment. Thank you.